In 1983, a strange ad appeared in the Wall Street Journal, not for a hot stock tip, not for a get-rich-quick scheme, but for something that would revolutionize trading forever. Richard Dennis accepts applications for the position of commodity futures trader to expand his group of traders. Mr. Dennis will teach successful applicants his trading methods. Successful candidates will then trade solely for Mr. Dennis. They will not be allowed to trade futures for themselves or others. Traders will be paid a percentage of their trading profits and will be allowed a small draw. Prior experience in trading will be considered, but is not necessary. Applicants must send a resume and, in 10 words or less, answer the question, "What makes you tick?" Over 1,000 people responded. Investment bankers, taxi drivers, blackjack dealers, PhDs, high school dropouts, all dreaming of learning from the legend who'd turn 1,600 into $200 million. 23 were chosen. Within 4 years, they'd collectively make over $100 million. One was a 19-year-old kid named curtisfaith, who'd make $31.5 million by age 23. Another was Jerry Parker, a quiet accountant who now manages billions. There was Liz Cheval, one of the few women who'd retire at 45, and Mike Carr, who'd turn a government salary into generational wealth. They weren't geniuses. They weren't born traders. They were turtles. The story you're about to hear is the ultimate case study in discipline, and it's what we're all about here at Trading Psychology Stick, finding the mental models that truly work. But because mastering psychology starts with taking full responsibility, please remember, this is an educational deep dive, not financial advice. Trading involves significant risk. Now, let's uncover the secret that made it all possible. It all started in a restaurant in Chicago. Section 2. The $1 Million Bet. Picture this. Lee Colonial Restaurant, Chicago, 1983. Soft jazz playing, expensive wine flowing, and 2 men arguing about the nature of success. Richard Dennis, 34, already a legend. Started with $1,600 borrowed from his family, now worth $200 million. The Prince of the Pit, they called him. He could move markets with a single order. Across from him sat William Eckhart, his best friend and trading partner, brilliant mathematician, chess master, and completely convinced Dennis was wrong. Trading can't be taught, Eckhart insisted, jabbing his fork for emphasis. You either have it or you don't. It's like perfect pitch or athletic ability. Dennis smiled. He had heard this before, from brokers who wanted to keep their secrets, from academics who'd never placed a trade, from everyone who needed to believe success was special, not systematic. Bill, I could take anyone, and teach them to trade exactly like me. Trading is a skill, not a talent. Bullshit, Eckhart shot back. You're a savant, Rich. You see patterns others don't, feel market rhythms others miss. That can't be taught. Dennis leaned forward. Want to bet? How much? How about we do better than money? Let's bet reputations. I'll prove great traders are made, not born. The experiment that followed would shatter every myth about trading. But first, Dennis had to find his students. Notice how your mind is already choosing sides. Are traders born or made? Hold that thought as you discover what happened next. Section 3. The selection. Choosing ordinary people. The applications flooded in. Doctors tired of medicine, lawyers sick of law, gamblers seeking a legal high, housewives wanting independence. Dennis and Eckhart spent weeks reviewing them, but they weren't looking for what you'd expect. I don't want financial experience, Dennis told his assistant. I want blank slates, people who can follow instructions without their own baggage. The selection criteria was bizarre. Could they handle being wrong 60% of the time? Did they understand probability over prediction? Were they comfortable with rules over intuition? Could they pull the trigger when terrified? One question eliminated half the applicants. If you could have a 55% chance of making $1,000 or a 45% chance of losing $1,000, would you take the bet? Most said no. They focused on the potential loss, not the positive expectancy. Dennis wanted the ones who said yes, who understood that profitable trading meant accepting calculated losses. From over 1,000 applicants, 40 made it to interviews. There was Michael Cavallo, 31, a government auditor who'd never bought a stock. I like rules, he said simply. Tell me the rules, I'll follow them. Jerry Parker, 33, soft-spoken accountant from Virginia. When asked why he wanted to trade, he said, I'm tired of making other people rich. I want systematic wealth, not random salary. Curtisfaith stood out immediately. Just 19, computer programmer, youngest applicant. Trading is just code, he told Dennis. If, then statements with money attached. I can do that. Liz Cheval had been a trading assistant, watching men make fortunes while she fetched coffee. I know I can do what they do, she said. I just need someone to teach me how. Jim Melnick was a sound engineer at a recording studio. His answer to what makes you tick was, solving puzzles nobody else can solve. After grueling interviews, 23 were chosen. They didn't know it yet, but they were about to enter the most intense educational experience of their lives. 2 weeks that would transform minimum wage workers into millionaires. Dennis called them turtles after visiting turtle farms in Singapore. We're going to grow traders like they grow turtles in Singapore. Slowly, systematically, perfectly. Feel that mix of excitement and skepticism? Good. That's exactly how the turtles felt, walking into their first day of training. Section 4. Day 1. Everything you know is wrong. January 30, 1984. Chicago Board of Trade Building. 23 nervous people in a conference room. Richard Dennis walks in. Forget everything you think you know about markets, he began. Your opinions are worthless. Your predictions are garbage. Your intuition is your enemy. The room was silent. This wasn't what they expected. We're going to buy high and sell higher. We're going to sell low and cover lower. We're going to lose money 60% of the time and get rich doing it. Michael Cavallo raised his hand. But isn't the goal to buy low and sell high? Dennis smiled. That's what everyone thinks. That's why everyone loses. We're not investors hunting for bargains. We're traders following trends. Big difference. He turned to the whiteboard and wrote, "The complete turtle trading system. This is it. Everything I'm going to teach you fits on this board. The entire system that made me $200 million. Entry rules. System 1. Buy 20-day breakout, exit 10-day low. System 2. Buy 55-day breakout, exit 20-day low. Add units at each half. N profit for pyramiding. Exit rules. Initial stop. 2N, which means 2 times average true range. Exit on 10 or 20-day reversal. Never move, stops away from position. Position sizing. Unit size equals 1% of account divided by N times dollar value per point. Markets to trade, bonds, currencies, commodities, indices, everything liquid. That's it? Jerry Parker asked. That's the whole system? That's it, Dennis confirmed. But knowing the recipe doesn't make you a chef. The difference between you and losing traders isn't information. It's execution. Curtisfaith was scribbling notes furiously. What about fundamental analysis? Economic reports? News? Worthless, Dennis said flatly. The market has already processed every piece of information better than you ever could. Price tells you everything you need to know. For 8 hours that first day, Dennis demolished every trading myth. Technical analysis, tea leaves, and astrology. Fundamental analysis, stories to justify random moves. Market prediction, impossible and unnecessary. Discretionary trading, ego disguised as strategy. By day's end, the turtles' minds were reeling. Everything they'd believed about markets was being systematically destroyed. But Dennis wasn't done. Tomorrow, he said, we'll talk about the real secret, position sizing. Get it right, and you can be wrong most of the time and still get rich. Get it wrong, and you can be right most of the time and still go broke. As you process this simplicity, you might feel resistance building. Good. That resistance is what keeps 95% of traders from ever implementing what actually works. Section 5. The Position Sizing Revolution. Day 2 of Turtle Training. Richard Dennis walked in, carrying 2 briefcases. One of these contains the secret to getting rich. The other contains the reason most traders go broke. Can anyone guess which is which? Silence. Dennis opened the first briefcase. Stacks of paper, complex charts, indicators, analysis. This is what most traders obsess over. Entry signals. It's worth maybe 10% of success. He opened the second briefcase. A single sheet of paper with one formula. Position size equals account times, bang, R1, divided by N times dollar per point. This is worth 90% of success. Position sizing. The most important decision you'll make, and most traders give it zero thought. He turned to the board. Let me show you why traders go broke even when they're right. Trader A, the amateur, $100,000 account, thinks gold is going up, buys 10 contracts because he's confident. Gold drops $50, normal volatility. Loss, $50,000, which is 50% of account. Game over. Trader B, the turtle, $100,000 account, gets systematic buy signal, calculates gold, N equals $25, proper size equals 4 contracts. Gold drops $50, A, 2N move, loss, $2,000, which is 2% of account, takes next signal. Same market move. One trader destroyed, one trader barely scratched. The difference? Position sizing. Mike Carr raised his hand. But what if trader A was right and gold went up? Great question, Dennis said. Let's see. If gold rises $100, trader A makes $100,000, doubles account. Trader B makes $4,000, 4% gain. Looks like amateur wins, right? Wrong, because here's what happens over 100 trades. He showed the math that would change their lives. Amateur approach with random sizing, win rate 50%, average win plus 100%, average loss minus 50%. Result after 4 trades, broke. One double loss wipes out everything. Turtle approach with systematic sizing, win rate 40%, average win plus 10%, average loss minus 2%. Result after 100 trades plus 100%. Account doubled. The amateur needs to be right about direction and timing and avoid all large losses. The turtle just needs to show up and follow the formula. Curtisfaith was mesmerized. So, position sizing is risk management? No, Dennis corrected. Position sizing is the strategy. Everything else is just implementation. He shared the advanced concept that would make them millions. N, average true range calculation. Take the higher of today's high minus low, today's high minus yesterday's close, or yesterday's close minus today's low. Calculate 20-day average of above. Updates daily. When sugar is moving $500 per day and bonds $300 per day, do you risk the same dollars? No, the class answered. Exactly. You risk the same percentage by adjusting position. Size. More volatile equals smaller position. Less volatile equals larger position. The market tells you how much to trade. Then Dennis dropped the bomb. And when you're winning, you add to winners systematically. Feel your brain trying to complicate this? That's your ego defending itself. Because if making money is this simple, what have you been doing all this time? Section 6, the pyramid principle. Who can tell me the fastest way to go broke? Dennis asked on day 3. Averaging down, someone offered. Close. The fastest way to go broke is adding to losers. The fastest way to get rich? Adding to winners. We call it pyramiding. The room looked confused. This went against everything they'd heard. Cut losses, let winners run was one thing. But adding more to winning positions? Dennis drew on the board. Traditional trader. Buys 10 units at $100. Price rises to 110. Takes profit from fear of giving back gains. Misses move to 150. Turtle pyramiding. Buys 10 units at $100 with 2% risk. Price rises to $102.50 plus 0.5N. Adds 8 units, total risk still capped. Price rises to 105 plus 1N. Adds 6 units. Price rises to 107.50 plus 1.50. Adds 4 units. Total 28 units for move to 150. Same initial risk, 5 times the profit. That's how I turned thousands into millions. Jerry Parker was skeptical, but what if it reverses after we pyramid? Show him the math, Dennis told his assistant. Pyramid risk management. Initial position, 10 units at 100. Stop at $98 minus 2N. Add 8 units at $102.50. Move all stops to $100.50. Add 6 units at $105. Move all stops to $103. Add 4 units at $107.50. Move all stops to $105.50. If it reverses from $107.50 to stop at $105.50, initial 10 units plus 55 profit. Second 8 units plus $30 profit. Third 6 units plus $5 profit. Fourth 4 units minus $8 loss. Net plus $82 profit even though last ad lost money. The turtles were stunned. The mathematics of pyramiding meant you could be wrong on most additions and still make money. This is how the big money is made, Dennis emphasized. Not by being right more often, but by being bigger when you're right. But then came the warning. Pyramiding only works with trends, and trends are rare, which means he paused for effect. You're going to spend most of your time losing small amounts, waiting for the few huge trends that make your year. Can you handle that? Notice your discomfort with that idea? Being wrong most of the time? That discomfort is why most traders never capture the really big moves. Section 7, the first real money. 2 weeks of training complete. January 16th, 1984. The turtles were about to trade real money. Some of you will get $250,000 accounts. Some will get $1 million. Some will get $2 million, Dennis announced. This isn't play money. Lose it and it's gone. Curtisfaith, the youngest at 19, was shocked when Dennis pulled him aside. You're getting $2 million. Why me? Faith asked. Because you have no bad habits to break, and because you asked the best questions during training. The first day was surreal. Jim Melnick sat at his desk, staring at the screens. I went from making $30,000 a year to controlling $1 million. My hand was shaking when I placed my first order. The initial results were mixed. Week 1, 5 turtles made money, 18 lost money, average loss minus 1.8%. Biggest winner plus 3.2%, Curtisfaith. Biggest loser minus 4.1%, nervous over trading. Perfect, Dennis said at the week's review. Most of you lost money. That's exactly what should happen when there are no trends. But knowing the theory and living the reality were different beasts. Michael Cavallo's journal from week 2 took signal in soybeans, stopped out. Took signal in Swiss franc, stopped out. Took signal in crude, stopped out. Down $47,000 in 5 days. The system feels broken. This was the first test. Would they trust the system or trust their feelings? Then came February 8th, 1984. Heating oil broke out. Every turtle got the signal, but their reactions revealed everything. The faithful took full position. Size. Curtisfaith, 15 contracts. Jerry Parker, 12 contracts. Paul Raybar, 10 contracts. The fearful reduced size after losses. Several traders, 5 to 7 contracts. 2 traders skipped entirely. Heating oil exploded, moved from 0.94 to 1.28 over 3 months. Results from that one trade. Curtisfaith pyramided aggressively, plus $3.2 million. Jerry Parker pyramided moderately, plus $1.8 million. Reduced size traders, plus $400,000 to $600,000. Those who skipped, $0 in psychological damage. At the quarterly review, Dennis made the lesson crystal clear. The traders who followed the system made millions. Those who used discretion made thousands, or nothing. But this was just the beginning. The real test was coming. Feel that tension between logic and emotion? Between knowing what to do and actually doing it. That tension determines whether you'll be rich or just right. Section 8. The Psychology of Systematic Losing. March 1984. The heating oil trend was over. Now came the harder part, the grind. For the next 4 months, the markets chopped sideways. Every breakout failed. The turtles' results: March, 23 trades, 19 losses. April, 31 trades, 24 losses. May, 28 trades, 22 losses. June, 26 trades, 21 losses. I'd wake up knowing I'd lose money, Paul Raybar recalled. The psychological weight was crushing. You start doubting everything. This was when the turtles discovered the difference between knowing the path and walking it. Tom Shanks developed a ritual. Every morning, I'd write, "The system works," 10 times. Sounds stupid, but it kept me from going crazy. Liz Cheval took a different approach. I stopped looking at P&L daily. I'd check positions, place orders, then cover the profit column with tape. I could only look on Fridays. But some cracked. David Cheval, no relation to Liz, started improving the system. This breakout doesn't look strong enough, skip. This market is too volatile, reduce size. This signal conflicts with the news, skip. By July, David had missed 12 signals. His account was down 8%, while pure systematic traders were down 15%. He felt vindicated. See? Using judgment works. Then August hit. Coffee exploded. Sugar rallied. Currencies trended. David, having lost faith, took signals half-heartedly, made 5% that month. The systematic turtles, up 40% to 60%. Curtisfaith's August alone, plus $4.7 million. David made the classic mistake, Dennis explained later. He optimized for avoiding pain, not for making money. In trading, those are opposite goals. But the psychological challenge went deeper. Success brought its own demons. Jim Melnick was up $2 million by September. I couldn't sleep. Not from losses, from gains. I'd never had money. Now I'm making more in a day than my dad made in a year. The guilt was overwhelming. The imposter syndrome was real. I don't deserve this. It's too easy. Something must be wrong. The luck will run out. Richard Dennis had seen it all before. In a group meeting, he addressed it. The market doesn't care about your feelings. It doesn't know if you deserve the money. It only knows if you followed the rules. Your job isn't to be worthy. It's to be systematic. Notice your own relationship with deserving success. That relationship might matter more than any trading system. Section 9, The $1 Million Mistake. September 12, 1984. Jim Melnick made an error that would haunt him and teach him everything. I was calculating position size for Deutsche Marks. The N was 0.05, account value $1.2 million. I multiplied wrong, bought twice what I should have. By the time he realized the error, Deutsche Marks were down 30 ticks. He was losing $15,000 per tick on double position size. Total drawdown, $450,000. My first instinct was to close immediately, cut the position, take the loss, move on. But then I thought, what would the system say? The system was clear. The stop hadn't been hit. Hold the position. Those were the longest 2 weeks of my life. I couldn't eat, couldn't sleep, watching $450,000 in red, knowing it was my mistake. Other turtles watched in fascination and horror. Would Melnick crack? Would he close the position? Day 10, Deutsche Mark stabilized. Day 12, small uptick. Day 14, breakout. The Deutsche Mark exploded higher. Not only did Melnick recover his loss, but the double position turned into his biggest winner of the year, $1.8 million profit. I got lucky, Melnick admits today. But the lesson was profound. Even when you screw up, following the system beats emotional decisions. Dennis used this as a teaching moment. Jim made 2 decisions. The first was a mistake, wrong position size. The second was wisdom, trusting the system even after the mistake. The second decision made him rich. But not all mistakes had happy endings. Philip Liu, the MIT graduate with the 180 IQ, made a different kind of error. He decided he could improve the system with filters. Only take breakouts with volume confirmation. Skip signals in overextended markets. Reduce size when volatility was too high. Each filter made logical sense, Liu explained. Combined, they should have improved performance. The reality. Q3, 1984. Liu plus 12%, Pure Turtles plus 45%. Q4, 1984. Liu plus 8%, Pure Turtles plus 38%. Q1, 1985. Liu minus 5%, Pure Turtles plus 27%. By April 1985, Liu quit. I couldn't handle being the smartest person in the room with the worst results. Dennis's response was brutal. Intelligence without discipline is worthless. Better to be a disciplined idiot than an undisciplined genius. Feel that urge to improve things? To add your own common sense to proven systems? That urge has cost more money than every market crash combined. October 19th, 1987, the day that would define careers, the day markets went insane. Tom Shanks walked into the office at 7 a.m., checked his positions, up $10 million for the year. Life was good. By 10 a.m., his life was chaos. The Dow was crashing, not falling, crashing, down 10%, 15%, 20%. Phones ringing nonstop, brokers screaming, traders crying, literal panic. I was short S&P futures, Shanks recalled. Should have been printing money, but the futures went limit down, no trading allowed. When they reopened, the gap was so big my stops were blown through by 50 points. His P&L, 9:30 a.m. plus $10 million year to date. 10:30 a.m. plus $2 million 11:30 a.m. minus $2 million. Market close minus $3 million. In one day, $13 million vanished. I went to the bathroom and threw up, Shanks admitted. Then I washed my face, went back to my desk, and checked for new signals. This was the difference between turtles and everyone else. While the world panicked, they followed their rules. Jerry Parker was in a different position, perfectly positioned for chaos. Short stock indices, plus $4.2 million. Long gold, plus $1.8 million. Long yen, plus $2.1 million. Long bonds, minus $3.1 million. Surprise correlation break. Net, plus $5 million. On the worst day in market history. I felt like I was in the eye of a hurricane, Parker said. Chaos everywhere, but my system kept me calm. Take signals, size positions, manage risk. Same as any other day. But the real lesson came the next morning. October 20th, 1987. Tom Shanks sat at his desk, down $3 million. Ego shattered, dreams destroyed. New signal, buy gold. Every cell in my body said, don't trade. You just lost $13 million. Take a break, regroup. But the system said, buy gold. Shanks bought gold. Gold rallied 8% in 2 weeks. Shanks made $1.2 million. By year end, he'd recovered to plus $3 million. If I'd stopped trading after Black Monday, I'd have locked in a $3 million loss. By following the system through the pain, I finished profitable. That's when I truly became a turtle. The contrast with non-turtles was stark. Regular traders, paralyzed by fear, missed the post-crash opportunities. Turtles kept taking signals, captured the violent trends that followed. Curtisfaith summarized the lesson. Black Monday wasn't a disaster. It was a filter. It filtered out everyone who traded with emotion instead of systems. Imagine losing a year's profits in one day. Now imagine trading normally the next day. That's the difference between systematic and discretionary. Section 11. The Turtle Diaspora. By 1988, the experiment was ending. Dennis had proven his point. Traders could be made, not born. But what happened next surprised everyone. The turtles scattered, each taking the DNA of systematic trading in the different directions. Jerry Parker went big, founded Chesapeake Capital, raised institutional money, built a $1 billion fund that would survive every crisis for 35 years. I realized Dennis taught us something bigger than trading, Parker explained. He taught us how to build systems that work without us. That's the real fortune. Curtisfaith went deep, wrote the definitive book on turtle trading, taught thousands, proved the student had become the master. My edge wasn't hiding the secrets, Faith said. My edge was showing that even with the secrets public, few could execute them. Paul Rabar went pure, kept trading the exact same system from 1983. No modifications, no improvements, just systematic execution for decades. Why change what works? Rabar asked. The market changes, but math doesn't. Liz Cheval went free, made her millions, and walked away at 45. Used systematic thinking to design her perfect life. Trading gave me freedom, she said. But freedom from trading was the real gift. Mike Carr went wide, applied turtle principles to stocks, real estate, businesses, built an empire on systematic thinking. Once you see the world through systems, you can't unsee it. Everything has an edge that can be systematically exploited. But not everyone thrived. The failures. Several turtles couldn't handle success. They'd learned to trade, but not to live. The money magnified their weaknesses. Addiction issues, failed marriages, identity crises, depression despite millions. We were trained to make money, one struggling turtle admitted. Nobody trained us for what came after. The quiet ones. Michael Cavallo disappeared from public view. No interviews, no fund. Just quiet, systematic wealth building. Estimated net worth today, $400 million. Everyone wanted to be famous, Cavallo said in his only interview. I wanted to be rich. Different games, different rules. The innovators. Some turtles evolved the system. Shorter time frames for less drawdown. Options overlays for income during chop. Sector rotation approaches. Cryptocurrency applications. But all maintained the core DNA. Systematic entries, mathematical position sizing, disciplined exits. Notice the different paths to success? The system was the same, but the expression was personal. That's the difference between copying and mastering. Section 12. When trends died, 2011 to 2019, trend following is dead. By 2011, you couldn't escape the obituaries. Financial media, academics, even former believers, everyone agreed the game was over. The evidence seemed overwhelming. Central banks intervening at every dip. Volatility crushed by money printing. Correlations going to 1.0. No trends, just chop. Jerry Parker's Chesapeake Capital, after 25 years of success, hit a wall. 2011, minus 11%. 2012, minus 8%. 2013, plus 3%. 2014, plus 15%. 2015, minus 2%. 2016, minus 13%. Investors fled. Assets under management dropped from $1.5 billion to $400 million. I got emails saying I'd lost my touch, Parker recalled. That markets had evolved. That AI and high-frequency trading had killed trends forever. The pressure to adapt was immense. Add filters for central bank meetings. Reduce position sizes. Trade shorter time frames. Add discretionary overlay. Parker's response? Nothing. Changed absolutely nothing. The hardest trade is staying systematic when systematic isn't working, Parker explained. But that's exactly when discipline matters most. Other turtles faced the same challenge. Paul Raybar, still trading the original 1983 system, endured brutal drawdowns. His investors begged him to modernize. I told them the system doesn't need to change. Our patience does. Trends aren't dead. They're dormant. Big difference. The temptation to tinker was overwhelming. Some turtles gave in. The adapters modified systems to fit the new environment. Shorter time frames, tighter stops, more filters, less exposure. The abandoners quit trend following entirely, switched to mean reversion, became value investors, tried arbitrage strategies, retired in frustration. The faithful kept trading the same rules. Parker, Raybar, Abraham endured the drawdowns, maintained discipline, waited. Then 2020 hit like a sledgehammer. COVID panic, market crash, central bank explosion, and suddenly trends everywhere. Violent, beautiful, profitable trends. Parker's Chesapeake Capital, 2020, plus 38%. 2021, plus 29%. 2022, plus 35%. The adapters who fixed their systems missed it, Parker noted. They optimized for the drought and couldn't capture the flood. The lesson was profound. Systems don't fail. Patience does. Salem Abraham, second-generation turtle, put it perfectly. Everyone wants to trend follow after a big trend. The real edge is trend following after years of no trends, because that's when they return with violence. Feel the weight of trading the same system through 8 years of losses? Most can't handle 8 days. That's the entire edge. Section 13. The second-generation revolution. They never met Richard Dennis, never sat in that Chicago conference room, but they might be more successful than the originals. The second generation of turtles learned from books, videos, and, if they were lucky, directly from the first generation. Salem Abraham was first. A Canadian grain elevator operator with $50,000 and a dream. In 1988, he read about Jerry Parker's success and did something audacious. He called him. "I'll work for free," Abraham told Parker. "Just let me watch." Parker, amused by the boldness, agreed. For 6 months, Abraham slept on a friend's couch in Richmond, Virginia, watching Parker trade. "I learned more in those 6 months than in 10 years of trying alone," Abraham said. Not about entries or exits. Anyone can learn those from a book. About psychology. About sitting still when every bone in your body wants to act. Abraham returned to Canada with Parker's blessing and $100,000 in backing. Today, Abraham Fortress Capital manages over $500 million. But here's what's fascinating. Abraham didn't copy Parker exactly. Longer time frames, 55/20 instead of 20/10. Fewer markets, deeper liquidity only. Options overlay, selling premium during chop. Same philosophy, personal expression. This pattern repeated across the second generation. Kevin Bruce learned from Paul Raybar. Started with $200,000 in 1995. Focused purely on commodities, no financials. Commodities trend cleaner, Bruce explained. Less manipulation, more supply and demand. Now manages $300 million. Elizabeth Cheval, daughter of Liz Cheval, applied turtle concepts to stock indexes only. Mom traded everything. I trade 3 markets deeply. Compound annual return since 2001, 22%. Marcus Chen studied under curtisfaith, the most innovative second-generation turtle. Took the system to cryptocurrency in 2016. People said crypto was too volatile for trend following, Chen laughed. That's like saying the ocean is too wet for swimming. Volatility is what we trade. Chen's modifications for crypto: 24/7 markets, no gaps, extreme volatility, smaller position sizes, limited history, shorter lookbacks, same math, different asset. Results: 500,000 to 50 million in 5 years. The teaching tree. What made the second generation special wasn't just their results, it was their openness. While first generation turtles were secretive, the second generation shared everything. Abraham. Regular podcasts explaining his approach. Bruce, YouTube channel with daily updates. Chen, open source crypto trading framework. Elizabeth Cheval, Women in Trading Mentorship Program. The first generation proved it worked, Abraham explained. We proved it's timeless. The third generation will prove it's universal. Risk 1 to 2% per trade, never more. Position size based on volatility. Trade the breakout, not the prediction. Add to winners systematically. Cut losses mechanically. Ignore everything except price. The lessons they added. Start smaller than you think. Focus on execution over optimization. Community beats isolation. Teaching solidifies learning. Systems are personal at the margins. Success is a process, not an event. Notice how mastery spreads, not through rigid copying, but through principled adaptation. The best students become teachers who create better students. Section 14, Modern Turtle Technology. If Dennis saw my setup today, he'd laugh, then he'd adopt it immediately. Salem Abraham manages $500 million from a converted barn in rural Canada. His technology would seem like magic to 1980s traders, yet his rules remain unchanged from 1983. The 1983 reality, quote, machine rental, $2,000 per month. Phone orders to floor brokers, hand-calculated position sizes, paper trading logs, next-day position reports. Tom Shanks remembers, I'd spend 2 hours each morning just calculating signals, another hour sizing positions. God help you if you made a math error. The 2024 reality. Abraham's command center looks like NASA mission control. 6 monitors showing 50-plus markets, automated signal calculation, one-click position sizing, real-time P&L tracking, cloud-based everything. Technology eliminated friction, Abraham explained. What took Dennis 2 hours takes me 2 minutes, but the decisions are identical. The modern stack, data infrastructure, tick data, 15-plus years historical. Live feeds, multiple providers for redundancy. Storage, PostgreSQL for time series. Backup, real-time replication to 3 locations. Execution layer, Abraham showed his actual position. Sizing code, calculate position. Size function. Account value times, risk percent divided by 100, then divide by ATR times dollar per point. Floor the result, always round down. 5 lines of code, 500 million managed. The automation debate. How much should be automated? The turtles are split. Team full auto. Kevin Bruce automated everything. The computer has no emotions. It can't skip signals. It can't reduce size from fear. Perfect execution every time. Team semi-auto. Jerry Parker insists on manual confirmation. I want to feel the trade. That moment of clicking submit. That's where discipline lives. Automation can breed complacency. Team hybrid. Abraham found the middle way. Signal calculation, 100% automated. Position sizing, 100% automated. Entry orders, manual confirmation. Exit orders, 100% automated. I automate the math, not the decision. The mobile revolution. Marcus Chen trades crypto from his phone. I've made million-dollar trades from a beach in Thailand. The turtles needed a trading floor. I need Wi-Fi. His mobile setup, custom app for signal alerts, position size calculator, one-touch order entry, real-time position tracking, dead man switch, auto exit if no activity. The danger zone. But technology brought new traps, over-optimization. With infinite computing power, you can backtest yourself into bankruptcy, warned Bruce. Find parameters that torture the data until it confesses. Information overload. First-gen turtles had one price feed. We have Twitter, Bloomberg, CNBC, Reddit, Infinite noise, said Chen. The discipline now is ignoring more information, not finding it. Speed addiction. Markets move faster, but trends last just as long, Abraham noted. Trading faster doesn't mean making more money, usually the opposite. The timeless truth. Paul Raybar, still trading at 68, keeps a 1983 HP calculator on his desk. Still works. Still uses it occasionally. To remind myself, he said, that Dennis made $200 million with this. All my fancy computers just help me do the same thing faster. The edge isn't in the technology, it's in the discipline to use it correctly. Feel that urge to find the perfect platform or indicator? That's your brain avoiding the real work, following simple rules consistently. Section 15. The Crypto Turtle Experiment. Marcus Chen sat in Curtisfaith's living room, pitching an idea that sounded insane. Crypto is the perfect market for turtle trading, Chen insisted. It's the 1970s commodities all over again. Volatile, inefficient, trending. Faith was skeptical. It's manipulated, unregulated, could go to zero. So was silver when the Hunts cornered it, Chen countered. You still traded it, and made millions. Chen had studied under Faith for 2 years, absorbing every lesson. Now he wanted to prove the system transcended markets. His thesis was simple. Crypto markets open 24/7, no gaps. Extreme volatility, bigger trends. Retail dominated, more inefficiency, limited history, less optimization. It's not about Bitcoin, Chen explained. It's about price movement. And crypto moves like nothing else. The initial test. Starting capital, $500,000. His life savings plus family money. Markets, top 10 cryptocurrencies by market cap. System, pure turtle rules with 3 modifications. Adjusted time frames, 10-day breakout, 5-day exit. Faster due to 24/7 trading. Smaller position sizes, 0.5% risk per trade due to extreme volatility. No pyramiding initially until he understood the market dynamics. Year 1, results 2017. The crypto boom was in full swing. Chen's journal from December 2017. This is insane. Bitcoin up 400% in 6 months. Ethereum up 1,000%. Every signal is working. I'm up 900% for the year. It feels too easy. But Chen had studied turtle history. He knew what came next. The 2018 crypto winter. Bitcoin crashed from $20,000 to $3,000. 85% drawdown. Most crypto traders were wiped out. Chen's results. Q1 2018, minus 22%. Q2 2018, minus 18%. Q3 2018, minus 15%. Q4 2018, plus 8%. Full year, minus 47%. Still better than buy and hold at minus 85%, Chen noted. And I was positioned for the next move. The evolution. By 2019, Chen had refined his approach. Market selection. Not all crypto trends equally. Bitcoin and Ethereum, core positions, most liquid. Major altcoins, trend followers. Small caps, avoided, too manipulated. Risk management, crypto-specific adjustments. Gap risk, reduced weekend positions. Exchange risk, spread across multiple venues. Regulatory risk, kept 50% profits in fiat. The big score, 2020 to 2021, COVID money printing, institutional adoption, the perfect storm. Chen's modified turtle system caught every major move. Bitcoin, $5,000 to $65,000. Ethereum, $100 to $4,000. Various altcoins, 10 to 50x moves. By November 2021, his $500,000 had become $50 million. Same math as soybeans, Chen said. Buy breakouts, size by volatility, ride trends. The asset doesn't matter. Mathematics matters. The crypto crash 2022. Chen gave back 40% in 2022, part of the game. But while others were wiped out, he was positioned for the next cycle. Crypto traders think they're different, Chen observed. They're making the same mistakes commodity traders made in the 1970s. Fighting trends, predicting bottoms, sizing by emotion. Lessons for modern turtles. New markets, old patterns. Human behavior creates similar patterns everywhere. Volatility is opportunity. If you size positions correctly, mania and panic create the best trending environments. Technology changes, mathematics don't. FOMO kills whether it's soybeans or Dogecoin. Chen now mentors crypto traders in turtle methods. I show them the 1980s soybean charts next to 2021 Bitcoin, identical. Different decade, different asset, same human emotions creating same patterns. Notice your reaction to crypto? Too volatile? Too risky? That's exactly what they said about commodities in 1983. Section 16, your first 100 trades. Want to know the difference between turtle traders and everyone else? The first 100 trades. Curtisfaith was addressing a room of aspiring traders in 2019. 3 decades after his turtle days, he'd discovered what really separated success from failure. Everyone can follow rules for 10 trades, maybe 20 if they're disciplined, but somewhere between trade 20 and 100, the real you emerges. He showed them the data from teaching thousands of students. Trades 1 to 10, the honeymoon. 95% follow rules perfectly, high enthusiasm. This is easy, usually profitable due to beginner's luck. Trades 11 to 30, the first test. First losing streak hits. 70% start adjusting rules. Maybe I should wait for confirmation. Confidence wavers. Trades 31 to 50, the fork in the road. Major drawdown likely. 50% quit entirely. 30% abandon system for new one. 20% push through. Trades 51 to 75, the darkness. Longest losing streak typically here. Self-doubt peaks. The system doesn't work anymore. Only 10% still following original rules. Trades 76 to 100, the transformation. Survivors start seeing results. Big trend finally hits. Discipline becomes habit. Systematic thinking emerges. By trade 100, you're either a systematic trader or you're broke, Faith said. There's no middle ground. The 100 trade challenge. Faith created a specific protocol. Setup phase. Define your exact rules, 1-page max. Calculate position size formula. Set up tracking spreadsheet. Fund account with tuition money, amount you can lose. Execution phase. Take every signal, no exceptions. Size every position by formula. Exit every trade by rules. Track every emotion. Documentation required. Screenshot of setup. Entry and exit prices. Position size calculation. Emotional state, 1 to 10 scale. Rule violations, if any. The tracking sheet. Faith showed his recommended format. Trade number, date, market, signal, size, entry, exit, P&L, emotion score, followed rules, yes or no. The spreadsheet doesn't lie. By trade 50, you'll see your patterns. Do you skip signals after losses? Reduce size when scared? Chase trades you missed? It's all there. Real student results. Maria Gonzalez, teacher from Spain. Trades 1 to 20, followed rules, plus 8%. Trades 21 to 40, 3 rule breaks, minus 12%. Trades 41 to 60, fixed system, minus 18%. Trades 61 to 80, return to original rules. Trades 81 to 100, caught trend, plus 45%. Final result, plus 23%, and transformed mindset. Trade 67 was my breakthrough, Maria recalled. 7 losses in a row, everything screaming stop. But I took the signal. It turned into a 15R winner. That's when I became a trader. James Park, engineer from Korea, followed rules perfectly for 87 trades. Broke on trade 88, doubled position from greed. Lost 8% on that one trade. Returned to rules immediately. Finished 100 trades at plus 31%. That one violation taught me more than 87 perfect trades, Park said. The market punishes arrogance instantly. The transformation markers. By trade 100, successful traders report. Emotional numbness to individual trades. Automatic position sizing. 0 prediction attempts. Comfort with being wrong. Faith in long-term edge. You stop being a person who trades and become a trading system that happens to be human, Faith explained. That's the transformation Dennis gave us. Now, it's yours to claim. Feel overwhelmed by 100 trades? Good. It should feel like climbing a mountain, because at the top, you're a different person. Section 17, The Modern Turtle's Daily Reality. 5:47 a.m., Salem. Abraham's alarm goes off, same time for 15 years. People think trading from home is freedom, Abraham says. It is. The freedom to be more disciplined than any boss would ever require. Let me show you what a day in the life of a modern turtle actually looks like. 5:47 a.m., the non-negotiable wake. No snooze, ever. The market doesn't have a snooze button, Abraham explains. Neither do I. 6 a.m., the scan. Coffee in hand, Abraham reviews overnight movements across 47 markets. Currencies, 8 pairs. Commodities, 22 markets. Indices, 12 markets. Crypto, 5 major coins. I'm not predicting, I'm observing. Did anything hit a 55-day high? That's all I need to know. 6:30 a.m., the calculation. Python script runs automatically, but Abraham checks manually. Markets at 55-day high. 3. Markets at 20-day low. 2. Current positions, 14. Available risk budget, 8 units. 7:00 a.m., the sizing. This is where discipline lives or dies. Natural gas hit a buy signal. Abraham calculates. Account value, $12 million. Risk per trade, 1% equals $120,000. Natural gas. ATR, 2100 position. Size, 57 contracts. Most traders would think, natural gas looks explosive. Let me bump it to 75 contracts. That thinking leads to bankruptcy. 7:30 a.m., the orders. Abraham places his orders. 3 new positions today, 2 exits, total time, 12 minutes. That's it. The work is done. Now comes the hard part. 8 a.m. to 3 p.m., the waiting. This is what nobody understands about systematic trading, the endless hours of nothing. Abraham's waiting routine. 8 a.m., 45-minute workout, non-negotiable. 9 a.m., read for 90 minutes, markets, psychology, history. 10:30 a.m., check fills, adjust if needed, 5 minutes. 11 a.m., write in journal. 12 p.m., lunch, walk outside, no screens. 1 p.m., personal projects. 2 p.m., meditation, 20 minutes. 2:30 p.m., final market check. 6 hours of waiting. That's the job. Sitting while positions move hundreds of thousands of dollars, doing absolutely nothing. The psychological warfare on this particular day. Crude oil position, minus $127,000. Euro position, plus $89,000. Cotton position, minus $43,000. Net, minus $81,000. The amateur would be adjusting stops, reading news, trying to fix the losing positions. The turtle, I go for a walk. 3 p.m., the review, end-of-day routine, update position tracking. Calculate next day's potential signals. Review any rule violations, usually 0. Close all screens. Trading ends at 3 p.m., period. The market runs 24/7, but I don't. The hidden battles. What Abraham doesn't post on Twitter. The family dinners missed for overnight positions. The vacations cut short for signals. The friends who don't understand the isolation. The constant battle against boredom. The weight of managing others' money. Success in systematic trading isn't about excitement, Abraham reflects. It's about enduring terminal boredom while making life-changing money. The monthly reality check. Abraham tracks his actual work time. Signal checking, 45 hours. Position sizing, 20 hours. Order placement, 15 hours. Total work, 80 hours per month. Total waiting, 400 plus hours per month. I make millions spending 80% of my time doing nothing. Try explaining that at a dinner party. Feel that discomfort with the boredom? That's why 95% of traders can't do this. They need action. Turtles need edges. Section 18, from zero to funded, the exact path. I get 50 emails a week asking the same question. How do I become a funded trader like the turtles? Jerry Parker was tired of giving vague answers. In 2023, he decided to map the exact path from zero to managing other people's money. It's not about finding a Richard Dennis to fund you. It's about becoming someone worth funding. Phase 1. Build your track record, months, 1 to 24. Starting capital. Required $10,000 minimum. Less than that, and you can't trade properly. More than that, and you'll trade carelessly. The proof system. Open account at major broker. Get third-party verification. Track record service. Trade systematically for 24 months minimum. Document everything. Nobody cares about your paper trading results, Parker emphasized. Real money, real results, real verification. Expected results. Year 1, minus 10% to plus 30%, learning curve. Year 2, plus 15% to plus 50%, finding consistency. Drawdowns, expect minus 20% minimum. Win rate, 35% to 45% typical. Phase 2, build your business infrastructure, months 18 to 30. While building track record, prepare for business. Legal structure, form, LLC or corporation. Register with state, get business bank accounts, hire securities attorney. Compliance preparation, Series 3 exam for commodities, Series 65 exam for securities, NFA registration if trading futures, state registration if needed. Cost reality, legal setup, $5,000 to $15,000, exams and registration, $2,000 to $5,000, ongoing compliance, $1,000 to $3,000 per month, total first year, $25,000 to $50,000. This is where dreamers become professionals, Parker noted. The costs and complexity eliminate 90% of wannabes. Phase 3. Find your first million, months 24 to 36. The 3 paths. Path 1, friends and family. Easiest to get, hardest to keep. Start with $100,000 to $500,000. Clear agreements essential. Prepare for relationship strain. Salem Abraham started here. My uncle gave me $100,000. Lost 20% in 6 months. Thanksgiving was awkward, but I survived, and he made it all back plus 400%. Path 2, seed capital firms. Professional funding for track records. Typically $1 to $5 million to start. Revenue split, you get 20% to 30%. They provide infrastructure. Seeders want to see 24 plus months of real trading, verified returns, and systematic approach, explained Kevin Bruce, who went this route. Path 3, direct institutional. Hardest path, but best terms. Need 3+ year track record, minimum $50 plus $1 million typically. You keep 1% to 2% management fee, plus 20% performance. The pitch deck reality. Parker showed what actually works. Slide 1, track record graph, nothing else. Slide 2, system rules, 1 page. Slide 3, risk management, position sizing. Slide 4, drawdown analysis. Slide 5, team, if any. Slide 6, terms. No stories, no predictions, no macro views, just results and process. Phase 4, scale or fail, years. 3 to 5. The brutal truth. 50% of new funds fail in year 1. 80% fail by year 3. 10% reach $100 million AUM. 1% reach $1 billion. Why they fail? Can't handle client psychology. Change system after drawdowns. Burnout from business demands. Compliance violations. Key person dependency. The success formula. Parker's principles for scaling. Trade exactly the same at $100 million as $1 million. Communicate boringly, but consistently. Hire operations before you need them. Turn away wrong-fit clients. Preserve capital in drawdowns above all. Real numbers from real managers. Year 1, $2 million AUM. Revenue, $60,000 in fees. Expenses, $120,000. Net, minus $60,000 live on savings. Year 3, $20 million AUM. Revenue, $600,000. Expenses, $400,000. Net, $200,000. Finally profitable. Year 5, $100 million AUM. Revenue, $3 million. Expenses, $1.5 million. Net, $1.5 million, real money. It takes 5 years minimum to build a real business, Parker concluded. Most quit at year 2. That's why most aren't running funds. Feel daunted by the timeline and costs? Good. This isn't a get-rich-quick scheme. It's a build wealth systematically blueprint. Section 19, the ultimate turtle wisdom. After 40 years, what have the turtles really learned? In 2023, the surviving original turtles gathered for a rare reunion. The accumulated wisdom in that room represented billions in profits and millions in losses, decades of discipline and moments of failure. Curtisfaith stood up first. If I could tell my 19-year-old self one thing, it would be this: the money is the easy part. Staying human is the challenge. Jerry Parker on success. I thought making millions would solve everything. It doesn't. It amplifies everything. If you're unhappy poor, you'll be unhappy rich, just with better toys. Paul Rabar on longevity. I've traded the same system for 40 years. People ask if I'm bored. Bored? I'm free. Free from decisions, free from stress, free from prediction. Systematic trading gave me freedom from trading. Liz Cheval on balance. The market taught me when to hold on and when to let go. That lesson saved my trading account and my life. Know when to exit everything, including trading itself. Mike Carr on wealth. First million, excited. 5th million, confident. 10th million, anxious. 20th million, philosophical. True wealth is knowing when you have enough. Tom Shanks on failure. I've lost more money than most people see in a lifetime. $10 million in a day, $30 million in a month. You know what? Still here, still trading, still grateful. Survival is success. The unified theory of turtle trading. After hours of discussion, they distilled 40 years into principles. The market principles. Markets trend 30% of the time. Catching 3 to 4 big trends per year is enough. Missing one big trend can ruin your year. Position sizing determines survival. Exits matter more than entries. The psychology principles. Discipline beats intelligence. Systematic beats discretionary. Boring beats exciting. Patience beats action. Process beats outcome. The life principles. Money amplifies who you are. Success requires sacrifice. Balance prevents burnout. Teaching completes learning. Exit strategies apply to life too. The surprises after 40 years. What they expected. Trading would get easier. It didn't. Money would bring happiness. It didn't. Success would feel satisfying. It didn't. They'd want to trade forever. They didn't. What actually happened? Trading became automatic, but never easy. Money brought options, not happiness. Success felt empty without purpose. Most found meaning beyond markets. The modern application. Salem Abraham, representing the second generation, added, "The original turtles proved the system works. We proved it's timeless. The next generation will prove it's universal, across all markets, all time frames, all technologies." Marcus Chen, the crypto turtle, concluded, "Whether it's soybeans in 1983 or Bitcoin in 2023, the math is identical. Buy strength, sell weakness, size by volatility, ride trends. Everything else is noise." The final challenge. Curtisfaith ended with a challenge. We've given you everything, the exact rules, the position sizing, the psychology, the path from zero to millions. Only one question remains. Will you actually do it? Because knowing and doing are different universes. We've shown you the bridge. Walking across it, that's on you. The room fell silent. 40 years of wisdom distilled to one truth. The system works. The question is whether you will. Feel the weight of that challenge? 4 decades of the proof in front of you. No more excuses, no more searching. Just a choice. Systematic wealth or continued randomness. Section 20. Your 90-day transformation. Blueprint. Give me 90 days of perfect discipline, and I'll give you a lifetime of systematic thinking. Curtisfaith developed this blueprint after teaching thousands. It's the exact path from amateur to systematic trader. Days 1 to 30, the foundation phase. Week 1, system design. Day 1 to 2. Write your complete trading rules. Entry criteria, 20-day breakout or similar. Exit criteria, 10-day low or similar. Position sizing formula, markets to trade, 1 page maximum. If it's longer, it's too complex. Day 3 to 4, backtest your rules. Minimum 100 historical trades. Calculate win rate. Expect 35% to 45%. Calculate average win/loss ratio. Verify positive expectancy. Day 5 to 7, set up infrastructure, brokerage account, tracking spreadsheet, price alert system, daily routine schedule. Week 2, mental training. Day 8 to 10, meditation and mindset. Start 10-minute daily meditation. Read Trading in the Zone by Mark Douglas. Write your trader's constitution. Day 11 to 14, visualization and planning. Visualize following rules perfectly. Visualize handling losses calmly. Plan responses to various scenarios. Create pre-trade checklist. Week 3, paper trading preparation. Day 15 to 17, demo account setup. Fund with realistic amount. Set up exactly like real account. Practice order entry. Test position size calculations. Day 18 to 21, first paper trades. Take every signal, size every position by formula. Document every decision. No real money yet. Week 4, building habits. Day 22 to 24, routine establishment. Wake same time daily. Check markets same time. Calculate signals systematically. End trading same time. Day 25 to 28. Stress testing. Trade when tired. Trade when emotional. Trade after losses. Prove system independence. Day 29 to 30. Month 1 review. Analyze all paper trades. Identify any rule deviations. Calculate theoretical results. Prepare for month 2. Days 31 to 60, the execution phase. Week 5 to 6, systematic paper trading. Minimum 20 trades, perfect rule following required. Document emotional state. Weekly performance review. Common week 5 challenges. This signal doesn't look good, take it anyway. I should increase size here, don't. Let me check the news, don't. Maybe I'll skip this one, never. Week 7 to 8, advanced scenarios, practice handling. Multiple simultaneous signals, pyramid opportunities, correlation decisions, drawdown periods. By day 60 requirements, 40+ paper trades completed, 0 discretionary decisions, positive expectancy proven, emotional control demonstrated. Days 61 to 90, the integration phase. Week 9 to 10, micro real money. Day 61, fund real account. Amount you can lose without emotion. 10% of normal position size. Focus on execution, not profits. First, real trade reality. Your hand will shake, your heart will race. You'll want to watch every tick. Don't. Place the trade and walk away. Faith. Week 11. Gradual scaling. If perfect execution, scale to 25%. If any violations, back to 10%. Document everything. Join trader community. Week 12. Full integration. Day 85 to 90. Final phase. Trading becomes automatic. Emotions under control. System fully internalized. Ready for lifetime journey. The 90-day success markers. 50+ trades logged, paper and real. Positive expectancy verified. 0 emotional trades in 30 days. Daily routine established. Support system in place. Written plan memorized. Confidence in system, not outcomes. Real success stories. Anna Rodriguez, nurse. Day 1, terrified of losing. Day 90, comfortable with systematic risk. The transformation wasn't just in trading. I became more systematic in everything. David Kim, programmer, failed twice before finding this blueprint. The difference? Structure. Every day had purpose. By day 90, I wasn't thinking about trades, I was executing automatically. Common failure points. Day 15 to 20, first losing streak in paper trading. Day 35 to 40, boredom sets in. Day 61, real money creates fear. Day 75, temptation to increase risk. The lifetime habit. 90 days is just the beginning, Faith emphasizes. It takes 90 days to build the habit, 900 days to build the fortune, 9,000 days to build the legacy. But it starts with day 1. As you read this blueprint, you're making a choice. Start day 1 tomorrow, or remain where you are forever. The market doesn't care, but your future does. Your beginning, the choice you've just absorbed, 40 years of trading wisdom, the exact system that created multiple millionaires, the psychology that sustained them through chaos, the blueprint for your own transformation. Now comes the only moment that matters. Right now, as you read these words, markets are moving, trends are forming, opportunities are emerging. Fortunes are being made by systematic traders who were once exactly where you are. They weren't special. They weren't chosen. They simply made a decision and followed through. 2 paths diverge. Path 1, close this script, search for the next holy grail, continue the cycle of hope and disappointment. Stay exactly where you are. Path 2. Accept that you have everything needed. Begin the boring, difficult, profitable work of becoming systematic. Transform your trading and your life. The market is calling, somewhere right now. A trend is starting that will run for months. A systematic trader is quietly taking the signal. Discipline is being rewarded with profits. Someone is building generational wealth with simple rules. Will that someone be you? Your first 3 actions. Tonight, write your trading rules on one page. Entry, exit, position sizing. Nothing fancy. Just clear rules you can follow. Tomorrow, start your trading journal. Trade number 1 begins your 100 trade challenge. Paper or reel, doesn't matter. Starting matters. This week, join a community of systematic traders. Isolation kills more traders than losses. Find your tribe. The Turtle Promise. If you follow the system for 100 trades, truly follow it without deviation, you will be transformed. Not might be, will be. The math doesn't lie. The edge is real. The only variable is your discipline. Richard Dennis's final secret. Years after the turtle experiment, Dennis revealed one last insight. I didn't really teach them to trade. I taught them to trust. Trust the math, trust the process, trust themselves to follow simple rules. Everything else was details. That trust is now yours to claim. Don't let this be another video you watch and forget. The turtles succeeded because they acted. Knowledge without action is worthless. Right now, make a commitment. Not to me, not to anyone else. To yourself. Type in the comments, Day 1 begins now. I am the system, then start, tonight. With one simple rule, one position and size calculation, one commitment to discipline. Because in 90 days, you'll either be a systematic trader or you'll still be searching for secrets that don't exist. The turtles proved ordinary people can achieve extraordinary results. They lit the path. Now, it's your turn to walk it. Welcome to the way of the turtle. Your transformation starts with 3 words. Day 1 begins. The market is waiting. Your fortune is calling. Your systematic future beckons. All that remains is for you to answer. In the end, we are all self-made, but only the successful will admit it.